Hey, good morning, everybody, and welcome to this Tuesday, September 16th, 2025 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with all of you this morning. Just recently got back from Redmond, Washington, had a great trip out west with a lot of the stock charts folks. Really good friends of mine. Actually, I was thinking about it. It's coming up on 20 years now that I've been writing over at Stock Charts. Pretty amazing. But I started writing there in 2006. Um, Still never forget the day because it was an opportunity for me to write alongside John Murphy in the Chart Watchers newsletter. And John Murphy is one of the few folks that I've actually learned from in the market or over the years. I mean, maybe more recently there's some others that I enjoy following, probably picked up a few things here or there, but I'm talking about when I really started first trading. I would say John Murphy was probably the only one really that had a major impact on how I viewed the market. A lot of his intermarket research that he did kind of inspired me to do a lot of the things that I do. Anyhow, it was great being out in Redmond, Washington last week. I was able to do one of my shows live from their studio, which was pretty cool. It's been a while since I'd been out there. We had some discussions, talked about a few things that maybe we could collaborate on going forward. We'll have more information on that with our members at Earnings Beats as we move forward. A little bit too early to share any of that. Got to get some things in place first, but probably by the end of the year, there will be some notable improvements, things that we're doing with stock charts. So really looking forward to that. But now we turn our attention back to the stock market, and we got a big Fed meeting starting today and tomorrow, 2-day meeting. And of course, on Wednesday at 2 p.m., they'll make their decision. I think just about everybody in the market is expecting a 25 basis point cut, which would finally resume the cuts that we had at the end of 2024. It would mark the first rate cut in 2025. And it also would follow suit with what the European Central Bank's been doing, which has been cutting rates for quite a while. And so I think it's time. I think finally the Fed gave up on its thoughts that the tariffs were going to have a huge impact on inflation. We still have the tariffs. We still have the issues, yet we really haven't seen much in the way of inflation in 2025. And I think that's given the Fed reason to think more about the economy and employment or unemployment, and trying to figure out, what they can do to help the economy, which seems to be weakening a bit. Not horribly, but when you look at the non-farm payrolls report for the last 4 or 5 months, you see an economy that's really struggling to generate jobs. Last week's initial jobless claims jumped unexpectedly to 263,000. I think the Fed is now realizing that they can't leave rates higher for longer, which was their mantra for a while, figuring that, hey, as long as the economy was still okay, why cut rates? Well, I think now they've gotten to the point where they realize that the economy is beginning to teeter a little bit more, and as a result, they are ready to cut rates again. I think that's what we're going to hear on Wednesday at 2 o'clock. I think a big question is, what do they say about the next two meetings? Are they anticipating that they will continue to cut? Are they going to say they're data dependent? Are they going to say, well, let's just do one and see what happens? I think that's what the market's going to be looking at, because there is over a 90% chance, at least that's what's being priced in, that we're going to get a 25 basis point cut on Wednesday. So that part of it is kind of, it's part of a foregone conclusion. I mean, I think just about everybody realizes we're going to get a rate cut. So that sets up the possibility of buy on the rumor of a cut, sell on the news of a cut. And the reason that that's kind of an interesting theory at this point is because it is September 16th. And we know that from September 1st through September 16th close, that's the best part of September, where we actually have annualized returns of over 7% since 1950, positive 7%. So we talk a lot about September being a negative month, but it's all because of the second half, or at least from the close on the 16th to the close on the 30th. Actually, more like the close on the 27th. But let's just call it second half of the month, the start of the 17th, which would be tomorrow, Wednesday, through the end of September. That period since 1950 has produced an annualized return that has been that's worse than minus 25%. That is, as far as I know, I'd have to go back and double check, but I'm pretty certain that is the worst half month of the year by far. Now we do have a worse week. The worst week within this second half of September is actually next week. So it's the 20th to the 26th. And so next week is the 22nd through the 26th. So if you're looking, you're keeping track and you really follow historical patterns closely, it's actually next week where the biggest weakness comes in, but it does start this week. We'll see what happens with the, after the Fed meeting and whether or not we do see that sell off. But it's something to be thinking about as we approach not only today and tomorrow, but also the rest of September. So, and I think that's the question that most people are asking right now. It's where does the market go after the rate cuts start? I mean, everybody's anticipating. So do we keep going higher? Do we pause and then maybe go higher later? Do we actually have a pullback? I mean, is it now that we've got a potential sell on the news, everything's priced in, is it time for the market to sell off? I think those are probably the three most talked about scenarios as we move forward. And I think from my perspective, it's really what's important to you. I do think that the second half of September historically could produce some problems here just because it has such a notorious history. That's number one. Number two, I think what's important is what's your timeline? What's your time frame? Are you talking about what's going to happen over the next week or two? Or are you talking about what's going to happen through year end or over the next 6 months? Because I could come up with a couple of different answers based on time frame. I'm bullish the market, and I'll show you some charts today that tell me that it's very, very unlikely that this market is going lower, at least meaningfully lower. I believe we're going higher. But I do recognize, again, second half of September, we're overbought. We got news coming out that's probably going to be exactly what the market's been expecting. So all the things that have been bought leading up to this announcement, you might see some of those things sold afterwards. So some of the interest rate sensitive areas that have moved, already seeing a little bit of selling in regional banks the past couple of days, which is a little bit unusual. But at the same time, this is a group that's made a really big move in 2025. And a little bit of consolidation is never a bad thing when you're in an uptrend. So again, if I look out further, 3 months, 6 months, I see a market that wants to go higher. But anyway, let's go ahead and let me get you set up here on charts. And let's take a look at what's going on here. So first, you can see yesterday Dow Jones Industrial Average up 49 points. That was only 0.1%, no big deal. But as we looked at some of the more aggressive areas of the market, S&P 500, which has a little bit more growth than the Dow, was up 31 points, or nearly 0.5%. And if we really start to get more aggressive, we look at the NASDAQ, we're looking at almost 1% gain on the NASDAQ, jumping more than 200 points, back well above that 22,000 level. So you can kind of see yesterday's action was a little bit more in favor of risk on types of areas of the market. Small caps, mid caps, both kind of languished, which we've been seeing. And it's not a huge surprise. I'll pull up the IWM here in just a minute. But small cap IWM, that's the ETF that tracks the Russell 2000. We went right up to 241, which is key, 240, 241, which is key resistance. We've never had a close on the IWM over 241. We've had some intraday action up there, but no closes. So when we got above 240, that was a really big level where we saw a lot of sellers just sitting and waiting. And so we backed off 238, 239 on the IWM. Again, technically not surprising when you go up right up against an all-time high. And this came back in, I think, November of last year. So it's been a while. We get back up there, and I think you have a lot of sellers waiting for you. But I think the fact that we're going to have continuing rate cuts, because I don't think this is going to be the only one. I think the Fed is going to cut tomorrow. I do think they're going to cut 2 more times this year, because I don't think inflation is going to be a problem. And I know there are a lot of folks out there saying, why cut? Why not just leave things as is? I mean, we don't have inflation. Why not just leave things? Well, 2 reasons. Number one, you've got the economy to think about. And it's not just what we're doing right now. You might say, well, jobs are still positive. We just got a retail sales report out this morning, very strong. I think it rose 0.6%. And I think the market was expecting either 3 or 4/10 rise. I'll look at that in just a minute. But, we've got an economy that's still doing okay. So why cut? Well, it's because the market is seeing, or because the Fed is likely seeing deterioration in the economy. And you don't want to sit back and just wait. That's what they did with inflation. Remember, they said it was transitory. And so they're like, we're just going to wait. It's a supply side issue. It's not demand. They waited and they waited and they waited. And then they realized, wait a minute, it's getting worse. And finally, they had to start they had to start raising rates. But by the time they started raising rates, the market had already gone into a cyclical bear market because they were too late to the party. Part of what the Fed tries to do is it tries to look to see what the trends are, to see where we're heading, and to try and change the course of that before it actually happens. They were late on the inflation issue, and it cost us. It was a cyclical bear market. If they're late again, and remember, when they stopped cutting rates back in December of last year was the last one. So once they started saying, hey, we're not going to cut rates anymore, what happened to the stock market? Remember, we talked about this the end of January, early February. I said, I'm 100% cash. The signs were starting to build. The market was going to go lower. There was a really good chance. I thought the risks, and then when I call the market, that's what I call it, based on the risks. I don't have a crystal ball. I don't know the market's going to go up or down. But when I start seeing signs that tell me that Wall Street's preparing for a move to the downside, then yeah, you bet I'm going to recognize those risks and I'm going to get the heck out. Or I'm going to be sitting on the edge of my seat with my one finger on the sell button, not taking any chances. That's a different animal than what we're looking at right now. I'm not seeing those same signs. So that's kind of where we are as we head into, these next couple of days. We'll see where things fall out tomorrow after the announcement. I always like to see how the market trades the 2 hours after the market announcement at 2 p.m. Eastern. That'll give us some clues. How the market trades the next couple of days after that will give us more clues. But what I can tell you right now is that the clues the market's giving is that we're going higher, that this is a sustainable market rally. And so, you can bet against it. Short term, I think it's a coin flip. But I think down the road further, I think this market's going higher. All right, let's take a look at the S&P 500. Let me see if we can get this. All right. I don't know why it's. Let's try this again. Just trying to get the charts all on one screen. There we go. All right, so here's the S&P 500. Kind of zero in over here, but you can see it's been another steady climb, closing yesterday above 6,600. It's just 100 points at a time. Seems like the market just keeps going up. I know a lot of folks back in April thought I was crazy when I stuck to my guns. I said the S&P 500 beat 7,000 by year end, even though we were hit 4,800 and change back in April. But we're going to hit 7,000 by year end. It's coming. Just a matter of whether or not we get there sooner or later in the year. My gut feeling is, just because it doesn't happen often. I went back the last 10 years, And I think the best September we've seen in the last 10 years was the S&P going up 2%. Now, if we look at where we are right now and where we were to open the month, well, we closed August at 64.60. Now, if you take 2% of that, that would be 129 points. And you add that, that would be 65.89. We're at 66.15. So if we don't gain another point between now and year end, this will be the best September since we've been in this secular bull market. Doesn't have to go up another hundredth of a point. It can just stay right where it is. This would represent the best September we've seen in this secular bull market. Now, we've had multiple years, multiple Septembers where we've seen the S&P drop 3% or more. We had one period a few years ago, I think it might have even been in 2021, when we had that big up year. September actually went down, I think 7%. I might be mixing up my years, but I think 2021 was one of those years that got hit pretty hard. But we've had multiple years where the S&P's dropped 3% or more, whereas we haven't had any where we gained more than 2% in the month of September. So we're flirting with something that we haven't done in the last 13 years. Is it going to hold up? I don't know. Honestly, I don't know. I think short term in the market's really hard to call. I think we're overbought. I know the history of the stock market is pretty popular adage in the market, buy on rumor, sell on news. So this absolutely could be a buy on the rumor of a rate cut. When we get the rate cut, we could see a sell-off, which would play perfectly into the hands of history. So each individual has to decide, what kind of risk do you want to take? I believe, personally, from a long-term perspective, I would stay with the market and take my chances with the end of September because I'm seeing signs we're going higher, even if we do pull back short term. So as a long-term investor, are you really going to try and time when the bottom happens? If it does pull back, is it going to be 1%? Is it going to be 2%? Is it going to be 5%? And are you going to be able to accurately time that to get back in to start up your buy and hold again? I don't know. That's the risk you take from a long-term perspective of selling. I think that is a good choice when the market is beating us over the head that we're topping. When the risks really start to elevate, I think long-term folks should take notice because you don't want to ride out a 10 or especially a 20% drop in the market if you can help it. And if you move out of the way in those 20% moves and then get back in after a 20% drop, the difference in your retirement or whatever you're saving for is massive. So that's, and that's one of the things that we get back, a lot of the feedback we get at Earnings Beats is that's why folks, a lot of members value our service so much, is because we've been able to accurately predict some of those big drops where folks can get out, get back in at a much lower price later on. It's not just Wall Street that can do it. We can do it too. But you've got to understand the signs and you got to be willing. It's a risk. Anytime you jump out of the market, even if you think things are going to get bad, there's still a risk. What happens if the market keeps going up? I jumped out at the end of January, and by February 19th, we were at another all-time high. But none of the signals were improving. And ultimately, that marked our top. And then we had that big drop over the next 6-7 weeks, which took us down to that early April low. Anyhow, this is the S&P 500. This is where we stand. Let's pull up the NASDAQ 100. Same thing, breaking out the new highs. It's definitely been more of a risk on. It's been more growth oriented here over the course of the last few days, which for me is a little unusual this time of the year. But at the same time, it's very comforting from a bullish perspective to see money rotating into growth anytime, because that would be the last place you would want to put your money right before a big drop. If Wall Street's moving in and we're seeing a lot of accumulation in growth areas, it's very, very unlikely that we are nearing any sort of major top. And let's keep in mind, once we get past the second half of September, we're going into the most favorable time of the year. And there has yet to be a bear market that has started in late September. Even though it's a really bad time of the year, Normally, the summertime is not great overall. So normally you're not speeding into the summer and then marking a high in September, later, latter part of September, right before you go into the best seasonal period of the year. So if you're thinking this is going to start a bear market, you're going to be out on a limb, not just among current folks looking at technicals, but historical folks going back the last 75 years. We haven't seen that happen. So again, could we pull back a little bit in the short term? Yes. That's more of a trader concern than it is a long-term investor concern. So that's kind of where I see it right now. I'm still just kind of picking my spots, even though the market's breaking out to all-time highs. There's still a lot of individual stocks that are pulling back. We're seeing rotation among sectors, individual stocks, industry groups. And so some stocks, some areas that were leading prior have pulled back. Number one, I'll show you KRE. I mean, this thing's pulled back for the last week or so while the market's going up. KRE sitting on the 20-day moving average, literally right on it. We closed at 64.36 and the 20-day is 64.36. So from a reward to risk standpoint, these are the kinds of stocks that are best to get in, not the ones that have just gone up, not Tesla. I mean, I love what Tesla's done, but now is not the time to jump in. It was 340, 345 3 or 4 days ago. Now, yesterday gets up over 420. Unfortunately, that's the way a lot of traders work. They wait until they see the stock go up and then they chase it. And then stock goes through a period of consolidation. You get impatient, you get out, you lose money, and then you chase something else. That's not the way we work at Earnings Beats. At Earnings Beats, our tagline is better timing, better trades. And that's the honesty. That's the truth. If you can wait, get stocks after they pull back that are in uptrends. I mean, look at a stock like Roblox. Roblox, very overbought. I mean, you could have chased and made money for a few months, but it took some time. Finally, for the first time in months, came down and tested its 50-day moving average. Now, the interesting part about that is if I pull up a chart with the AD line, look at this big pullback and look at the AD line barely coming back. And down at the bottom, while it was printing these hollow candles, the AD line actually went right back up to a 52-week high. So getting strong stocks when they pull back is the recipe to making a lot of money in the market, in my opinion. Now, doesn't mean you can't jump in to get some stocks that are doing really well and just keep riding them up. There's some stocks seem like they're never going to pull back. But if you recall, it was probably a few weeks ago, maybe a month ago, maybe 6 weeks ago, I don't remember. Probably can tell by looking at the chart. You remember Garmin? Remember after it went down here in our live trading room at Earnings Beats, when we were down here, I actually had bought Garmin. I think it was 222. And I think I said, hey, if it gets to 217, buy again. If it gets to 213, down in this range, to buy again. Look what Garmin did. After it had pulled back, and a lot of people see these big red candles, and that scares them off. They think, oh, this is awful. Well, in some cases, it's awful. But look what happened. Look at the AD line going right back to new highs well before we got back up to that price high. This was an opportunity. Some might say, well, you went below the 20-day moving average. Why would you get it then? Because price and volume is my number one indicator, price support. So let's annotate this chart. And let me show you the breakout on Garmin. A couple levels here. But the main one is kind of came down here, a little bit of a neckline, came down to a head, established a right side of neckline, pulled back just a little bit, and then broke out. Went all the way back up to this high. Or pretty close. Actually, I'll draw two lines, one at the intraday high, one at the closing high. But that range is what has created issues for Garmin when it gets back up to that level. But notice when we pulled back, this 220 and just under level was right near this key price support area. And if we go into the right shoulder right here and just put in a second, down in here, Could go all the way down to the intraday low, could go to this bottom over here before we gapped up. There's a lot of different levels, but bottom line is we didn't close below any of these. We didn't even close below this top one. If I just get rid of that, we gapped down below, intraday moved lower and came back and printed a hammer right on a major support level. And then look at what Garmin's done. It's come all the way back up to 240. So if you're always trading on emotion, then you're buying these moves to the upside, you're chasing. And then when you see a big move down, you're getting out. You get scared, you jump out. Not exactly good timing. However, if you wait, you jump at its support. And then, I mean, even recently, taking profits at 240, I'd have no problems with that. Let's see if it breaks through. If it does, you can always jump back in. You know, what do you give up? $2.5? I'd be okay with that. Anyhow, so that's, look at Garmin. But again, better timing, better trades. That's what we should all be doing. I want to pull up, actually, before I do this, let's just move over to, just want to make sure those of you who are new know where to find us. You can go over to earningsbeats.com if you are new to the program, or maybe just seen us a couple of times. Got a couple of things. Go over to Earnings Beats. You can start a 30-day free trial to our paid service. It's free for 30 days. Here you would have to give credit card, but we will remind you after the 30 days or prior to the 30 days, we'll remind you that your free trial is expiring and you're going to be charged the monthly rate, which, by the way, is $147. You don't want to do that. If you like our service, simply sign up for the annual. We'll give you a special prior to your trial expiring that will probably knock about 50% or more off of that monthly rate by signing up for an annual. So we're going to give you a great deal. But if you're not ready, you're still learning about the market. Maybe you're just not quite sure if you want to be part of a service. I get it. Scroll down because we have a free newsletter. No credit card required. Name and email address is all it takes. And you can become part of a community that now spans over tens of thousands of folks that have joined us. We provide valuable information twice a week, Mondays and Wednesdays. But make sure you hit that subscribe. That I want to just go back and show you the stock I gave yesterday. So Applied Materials. Why did I give Applied Materials? Well, kind of a couple reasons, but if you look at the chart, let me shorten this a little bit. I mean, there's really kind of a couple reasons, but actually, let's just leave this chart. So let's annotate this. And what I want to do is just kind of show you this line right here. Basically, that's a neckline. You might not be able to really see the pattern clearly. I'll give you a longer term weekly chart in just a minute. But here was the neckline. This was the prior high. Here was a left shoulder, neckline, head, neckline, right shoulder. And now here we come up through the moving averages. So we're just coming out of the right shoulder. And the reason I think this is important on Applied Materials is that two of their competitors, KLA Corp and Lam Research, they're already at all-time highs. Applied Materials has been lagging badly, but it is showing a bullish pattern that a move over 200 would confirm. So I think Applied Materials could start to play a little bit of catch up here. So let me get out of this. I want to show you that weekly chart now where you can kind of see this pattern. So here was the top all the way back here at 260. So we came down into this left shoulder, put in we had a reaction high back to 200. There's the neckline, head, right side of the neckline, right shoulder, and now we're starting back up. Now, we don't know that this is going to execute. If it does at 200, it actually measures up to about 275, which would go above the midsummer high we saw in 2024. And from 170, that's 100 points, 105 points from here. That's a pretty big move. And we also know that Applied Materials competitors, let's take a look at KLAC, at an all-time high. Lam Research at an all-time high. So when you pull up Applied Materials, first thing you realize is, okay, we have a relative laggard. So normally I like to go with the strength, but this is for those who are looking for value. This is for those who are looking for bottoms as opposed to momentum stocks or chasing strength. This would be the alternative. So just wanted to throw it out there. I think the stock looks like it's going higher. And if its peers are going up and breaking out to all-time highs, I think that's a good sign for the industry group. And so I think in time, Applied Materials is likely to show some relative strength and make that breakout and start playing a little catch up. So those are some of the things. That was from a free newsletter. So check that out. Make sure you go over to Earnings Beats, check it out. Also, you can help us right here in our YouTube community by clicking on that like button and subscribing to our channel. We do a lot of live stream shows. We're going to have another one coming up in a couple weeks. Don't miss out. Make sure you click that notification button or subscriber button and turn on your notifications. So click the like button, make sure you subscribe to our channel, and then once you're subscribed, make sure your notifications are turned on. That way, as soon as we, start a show on YouTube, you'll get notified. All right. So I want to show you, this is one of the reasons why I remain very, very bullish. So this is the XLY XLP. I'm going to bring this up and let's go back 25 years. And then the next thing I want to do, volume doesn't matter. Let's turn that off. I'm going to bring up correlation and how closely this ratio correlates to the S&P 500. So in other words, when we do this, and I'm going to move the height up a little bit here. So down here, this is the correlation. You can see at the very top is +1. At the very bottom is -1. So this correlation, the default, is that we're looking over 20 periods. In this case, it's a daily chart. So what we're doing is we're looking over the last 20 days and we're looking to see, does the direction of the ratio XLY versus XLP go in the same direction as the S&P 500 over these last 20 days? If so, if it's been like a perfect match that they're both going up together, it would be a +1 reading. Now, if they're going exactly opposite one another on a daily reading, then it would be a -1. And if it's anywhere in between, obviously he's going to fill in wherever. So if it kind of is going up sometimes, not others, kind of 50-50, then you're going to see right around 0. Now, as you look, now keep in mind, this is a daily chart, so it's not going to work every single day. But, I mean, we do live a lot in that 0.50 to 1.0 area. I mean, that's where most of the days are. And then occasionally we'll have, staples lead when the market goes up. It's not always discretionary. Remember, this is every, individual day. But notice one thing. We've never seen -1 hit. So it's never been XLY, XLP going straight up, S&P 500 going straight down, or vice versa. So there's that you need to think about. But if we now change this to a weekly, now we hardly go down below 0 at all. Now we're looking at what's happened over the course of a week. And you can see, again, mostly we stay right up here in this 0.5 to 1 range. Very clearly, this is a positive correlation. If change this, we'll go to monthly. I mean, look monthly. Look at where we are monthly right now. We tend to go in the same direction as the S&P. Now, is it perfect? No. Nothing in the market's ever perfect. But when you look at this weekly chart going back 25 years, I mean, we are only below zero on maybe 20 occasions in 25 years. That's less than once a year. And when we're going to see it, a lot of times that's when we do run into troubles. I mean, we went negative here, middle of 2021. We ended up topping at the end of 2021. We had a cyclical bear market. Same thing happened in 2024. Middle of the year, we went negative pretty seriously. And at the end of that year, we topped and we had another cyclical bear market. That's when the XLY, XLP turned lower. So did the S&P 500. But I'm going to bring up a daily chart again. I want to just show you. I want to show you the S&P 500 price. And then we're going to wrap the show up. All right, so I'm going to annotate here. First, you see here in January, actually, I mean, we could really go all the way back here to December. But see how we're making this move higher on the S&P 500 to end 2024 and begin 2025? And you notice here, when we go from this point, December to January 23rd, or whatever that high was, look at the ratio on the XLY, XLP. We're still fine, right? But look from January to February and look at what happened here. Now, all of a sudden, we're going lower. And then we really started to go to the downside. And the market fell apart. Then we started actually in through here, showing some signs, all these hollow candles. So a lot of gap downs, but then recoveries during the day and discretionary. That's why I think it was back on about April 11th or so. I think it was right in here, or right in here. I think the S&P was around 52 or 5,300. That's when I was actually in Florida at the time for a family medical emergency. But I remember talking to John Hopkins on the phone, and he was going to send out a note to our members, an update on the market. And I said, tell everybody I'm getting 100% in. That was back here on April 11th. So we did end up going back down just a little bit, not a lot, but then the market took off. And it was really just because a lot of the risk had been wrung out of the market back then. But this was 2025. I mean, do you see how the S&P was going up and this ratio started going down? That's not a good sign for the market. Look at what we're doing right now. The S&P is going up. The ratio is going up. This is good. This is, money is rotating into areas that fully support this rally. That's the way you need to look at it. I call it one of my sustainability ratios. Now, I could also go back. I want to go back to a predefined range. Or no, let's go back. I'm going to select the range. So let's go back to 2021, and we'll go back into like June. And then 2022. This will be the last thing I do. And then we're going to wrap up. I know we're a little late. Actually, we're a lot late. But let's update this chart. And so here we go. Now, this is going into the beginning of 2022, right? So let's annotate. Now, I want you to notice December high down to the January 1st high. That's the ratio. And then what I wanted you to look at is what's the S&P 500 doing? Wait a minute, going to a new high. So exactly what happened back in February of 2025 happened in January of 2022. We were going up and we saw a hit taking place. So that is a warning sign. By itself, that doesn't mean we're topping, but we had other warning signs at the time as well. So anytime I see this, I'm going to get nervous. But here, it truly started the 2022 bear market. That was one. Now, we had tons of other signals back in 2022. I mean, first Saturday in January of 2022, I remember we had our market vision event, and I told folks first 6 months of the year, I thought we were going to have a 25% cyclical bear market. And what did we do? First 6 months of the year down to June, we had a 20 to 25% cyclical bear market. I'm not psychic. I can simply read what the market's telling me. Wall Street was getting out of key areas like discretionary and getting into key areas like staples. That's not a good sign when the market's going up. That's normal when the market goes down because we tend to see profit taking in aggressive areas. So when the market goes down, you can see that. That's fine. It's when the market's going up and it's being led by defense. That's when you got to at least start thinking Wall Street is starting to rotate all of their massive resources into defensive areas. That's usually a warning sign. Wall Street's getting out. They're not telling us, well, they're telling us on the charts. They're not telling us on CNBC. If you're waiting for really good, timely news on CNBC, I just want to wish you the best of luck. It's not going to happen. They're going to tell you after the fact. John Hopkins, my partner, sent me a text yesterday. I think it was RBC. They said raised their S&P 500 target yesterday from 6,250 to 6,350. Can we all give them a golf clap? Good job. We're now at 6,600. Now you can raise it 100 points to 6,350. I mean, you can't make this stuff up. This is what happens watching CNBC. You're getting no news of value, no news to actually make your important financial life decisions. Follow earnings beats. Anyhow, that's it for me today. Let's get a quick look, see what the market's doing. We do have a Fed meeting. I suspect we're going to just see kind of sideways action. I was kind of thinking maybe the small caps might make their way back toward 240, 241 by midday tomorrow, just because it seems like the market gravitates toward key levels when a big number or big news comes out. So I would maybe be keeping an eye on the small caps, thinking maybe between now and tomorrow we get a little bit of recovery there. But otherwise, I'm not expecting a whole lot here while the market sits and waits. So anyway, have a great day, everybody. Happy trading.